Hey, good morning, everybody. It's Xavier here, home from another night shift at the hospital. So you see, I'm in my scrubs. Just got home from the night shift. So we were talking about, I've been following what's going on with the coronavirus ever since it basically started, and especially with what's going on in the stock market. Yesterday, I think it was yesterday or the day before, I had put out a video talking about which direction the market was going to go, where more likely the Dow was going to hit. And of course, we did hit what I thought the market was going to hit, which was 27K. I'll leave a description of the link. I'll leave a the link for the video that I talked about that yesterday. And of course, as we start to see more and more countries start to experience the coronavirus, and of course, kind of what's important about the coronavirus is one, it can be passed on to individuals who are asymptomatic. So it's different from, for example, people who have the flu, right? Typically, that person would have a cough, maybe they have chills, they have a productive cough, a fever. And when you come down with the flu, you kind of get like that achy feeling in your body, like something is kind of like working its way, right? Something's cooking inside the body, like we say. And then you wake up in the morning and you've kind of got, the back aches, the body aches, the joint pain. You might have a temperature, and then as the disease starts to progress, you may end up, developing a cough. Maybe you might get some post-nasal drip if you get maybe a secondary sinus infection. But with the coronavirus, you can be asymptomatic, and that's typically when you would stay away from somebody, right? When someone has the cough, the fever, the chills, to stay away from that person, to practice, good hand washing, maybe even, of course, if you're in a hospital setting or at home, you'd wear a mask to avoid the droplets, right? So that you don't inhale the droplets, and then of course, meticulous cleaning of wherever the person is, so that wherever it is that the person is coughing, you don't basically touch that surface and then touch your eyes or touch your mouth or touch your nose, or eat something and contaminate yourself. But with the coronavirus, you can feel just fine. And so that's one of the things that separates it from the common flu that we experience from year to year. The other thing is that at the very least, we have a flu vaccine, right, which minimizes the person's risk for receiving or for acquiring the disease, but it may also give you kind of like a weaker, you might get like, maybe you do get the flu, but you'll kind of get like, maybe it'll be less severe. But with the coronavirus, there isn't anything to fight off. The other thing is that it can be passed off via contact, via droplet, via airborne. And so that's what we're looking for. If a patient comes in, that patient would be, you'd be on complete isolation, like what you see in the videos where they're literally wearing, head to toe gear and like lab goggles, etc. To protect themselves. They're wearing protective, materials on their feet. Basically, literally every part of their body is completely covered to avoid contracting the virus and then spreading it to somebody else, spreading it to themselves, spreading it to other people that they come in contact with. And so this, of course, has a huge impact on every economy because it can be passed on so easily, especially things like the service industry, anywhere, factories, hotels. Obviously, companies like Carnival Cruise are going to be heavily impacted. Norwegian, any sort of service industry, like they're talking about canceling, the Olympic Games and canceling sports events. And so this, of course, has a huge factor on the economy. And this is what kind of the markets are now realizing. They were thinking maybe we're gonna, everybody's saying, oh, the coronavirus is it's like the common cold. It's like the flu, and the markets were kind of shrugging it off. And then, of course, yesterday and the day before rolls around, and the markets are now realizing that there are going to be huge impacts on different economies around the world, and certain countries that are being a little bit more lax, like for example Iran. The Iran health minister was sitting there on TV talking about how everything was okay and things were under control, and he's sitting there wiping himself down. The man was profusely sweating, and then the very next day he says, "Oh, I got the coronavirus." It's like the irony. And of course, the more people don't take these things seriously, the more it will spread, because it can spread for patients who are asymptomatic and as well as patients who are symptomatic. And so talking about where I'm looking at the, like I said the other day, right? For the better part of into 2017, 2018, all the way into almost the end of 2019, the market was struggling to break above 27K. You can see that I drew the trend line right here. You can see that the market multiple times tried to break above 27K, and it wasn't finally, and this is looking at this on the daily chart. Actually, we'll look at it here, make it a little bit easier to see. We'll look at it here. So this is on the weekly chart. You can see multiple times where the market was trying to break out above 27K. And so looking at the chart, it was kind of obvious that this was where we were going to go. This was our previous line of resistance, right? We couldn't break above 27K for literally the better part of 2 years, from late 17 up until just about the end of 2019. So it took about 2 years for the market to break above the 27,000 mark. So obviously that's the area where the market would come back. It's important to understand supports and supports and resistances. I know some people think that it's not important to look at technical analysis, but technical analysis is actually very important. It lets you, the trader, know where to pay attention to certain areas where the market will pull back, presents buying opportunities, or it lets you know where the market could exhibit some strength. You'd pay attention to how the market reacts to the 27K mark. You would see maybe a bounce, right? You would probably see a bounce back up to 28.2. If you look at the Dow on the daily, you can see that breaking just below that 28.2, the market was having a hard time breaking above 28.2. It took multiple weeks for the market finally to break above that 28.2. And of course, when the Chinese market opened, that's exactly where the market came back down to, just shy of the 28K. And so that's where I was thinking that the market was going to gap down, which it did, gap down way below into the 28K mark, and then quickly subsequently retested the 2017 all the way to the 2019 resistance level. And so looking at the market and thinking, are we going to go down from here, or are we going to bounce? I would say that the market is probably going to bounce maybe back up to 28K, and pay attention for a breakthrough of 27K. If the market literally just goes straight through 28K, I would probably hold off. Like if you're an M1 investor, I would probably hold off and wait for the market to come back down to 24K. If you remember back in the end of 2019, where the market subsequently sold off in the beginning of the end of 2018 all the way into the beginning of 2019, the market sold off from roughly 27K all the way down to 21.7, so just around 5,000 points. And I would say if the market was going to have a similar pullback, it would pull back from where we were at 29K right back down to the 24K mark. And that's just looking at the market and seeing how the market is going to react to coronavirus, and of course how different economies are going to react to the slowdown that is inevitable with the looming virus. As there's no cure for the virus. You literally just go through the virus, and either you get better or you start to experience respiratory complications as a result of the body killing off the cells that are basically corrupted by the coronavirus. And as a result, you experience upper and lower respiratory infections. And of course, that will, of course, impose other problems in terms of the healthcare systems. If there are too many acute cases, you'll see in country to country exactly what happened in China. If that were to happen, of course, they were to quarantine multiple parts of, basically multiple countries would have to quarantine huge sections of their population. That, of course, would have a huge impact on the market, which could cause the market to go into a recession. And if that was the case, the next resistance level you see right here, which would be 22K. If the market were continued, the next level we would look at would be 18K, which of course is a sharp pullback from where we are right now at where we were at 29K. And so these are the levels that I would say to be important to watch out for. Watch out, see if we get a bounce. If we don't get a bounce, I personally am going to hold off adding more money into my positions. I'll continue to add more money as cash into my M1 and into the rest of my accounts, but I'm going to wait until either the market hits 24K, and then I'll pay attention to see how the market reacts to 24K, or if the market starts to channel a little bit. Just for example, looking back at the market crash of 2008. Of 2008 into 2009, you can see, looking at it from even on the weekly, you can see more than likely, as we say, don't catch a falling knife. Don't sit there and try to time where the market is going to bounce. Wait for a market correction and then watch for another support and resistance level, which you can see right here, right? Looking at the market here, you can see that the market meandered for a while, for multiple months here at the 8,000 mark. Of course, the market came all the way back down. You don't know if the market is going to go below 6,000 or if the market was going to hit 5,000. But what you do see is you see a subsequent rally and then a hold of 8,000. The market bounces back up, where you can see the market did the exact same thing right here, where the market went from 18,000. The market tried to push above 9,000. And more sellers came in, and you see the exact same thing repeat itself, right? Because this is what happens this is what you look for with technical analysis. You look for how is the market reacting to what previously was an area of resistance. The same way you would look at to see how it reacts to areas of support. And so you can see the same thing. We see the pullback when it came close to 9,000, but the subsequent bounce off of 8,000, letting you know as a long-term investor that the market seems to be holding 8,000. It might be a little safe to start injecting liquidity into the market and start looking for positions that are looking to bounce, or looking for positions that are showing value. And you see subsequently the market comes in with a lot of rally, with a lot of volume that you can see right here over the past almost like a month here, right? Looking at this on the weekly, you can see literally a month's worth of just straight, where the market was just going straight up. So this is you that a lot of buyers were coming in. And then the only thing that you can do is keep paying attention to how the market reacts to both support and resistances. And this is, of course, whether you're investing like in an ETF that mimics the Dow or mimics the S&P, or if you're looking at individual stocks that are looking to rally. One stock that I'm paying attention to, of course, is Carnival Cruise. You can see Carnival Cruise right here. This, of course, is on the weekly chart, is coming down a little further down to where it finally broke out here. You see the exact same thing. Carnival Cruise basically quadruple bottoming, right? Back in 2000, 2001, and again in 2003, and then again in 2008, and then again in 2009, right? So it's important to look back and see where are areas where investors stepped in to buy. Where are we more likely to bounce based off of history, right? It's important to pay attention to what happened in the past. Looking at the chart over a series of weeks or months, it gives you perspective. You can't just look at what the stock looks like on this particular day or in this particular week or in this particular month. It's important to look at the market over a broad period of time so that you can pick a point where more than likely you'll see areas where a stock will more likely to bounce, where investors will be looking at the chart and showing what we had a previous area of support here at $20. The market may bounce there. The same thing here at the $30 mark. And so I'm kind of interested in watching Carnival Cruise as Carnival Cruise starts to pull back. Especially, it may take a long time for companies like this to recover, because we may see coronavirus become something similar to the flu, where it becomes seasonal. And of course, being stuck on a ship for multiple days where you're in close proximity to one another makes it really easy for you to basically catch things like the coronavirus or things like the flu, or you're in close quarters with other people. And of course, you're so close, and then maybe a lot of people don't practice hand hygiene. You can get things like E. coli because maybe someone doesn't wash their hands and they're eating at these large buffets, etc. Same thing with things like tea. I talked about tea, looking at tea on the long, like looking at AT&T. You can clearly see AT&T literally from all the way back to 2002 all the way to 2020, 18 years. Looking at the chart, that AT&T struggles to break above $40. So would you be someone who's, if you're looking, you like AT&T, I like the fundamentals, it's got a great dividend, I like the company, they're coming out, pairing with other companies, maybe they're increasing, coming out with 5G, maybe they're going to be going into like streaming services, etc. But looking at the chart, what does history tell me? History tells me that the market struggles, that AT&T struggles to break above the $40 mark. So would I look to buy AT&T here? More than likely not, unless there was a catalyst that seriously propelled the amount of earnings that AT&T was going to basically earn year over year. More than likely, AT&T will struggle to break above $40. So where would AT&T be more attractive? Probably around the $25 mark, where for multiple years, the stock was holding that $25 mark. You can see it right here, and then you can see it again right here, and then you can see the bounce, right? You can see where the market came down in 2019. We came really close to, what was it, that $26 mark? Let me see, the low of 26.29, right? So we see the market bounce off of what was for a long time, multiple years, an area where AT&T struggled to kind of break above that $25 mark. And finally, that area of resistance became an area of support. And so AT&T bounced off of that. And so that's where, even though you may want to nibble into AT&T, but I wouldn't sit there and go all in on certain stocks. You looking for stocks with strong pullbacks that present areas of opportunities where the stocks are presenting as either really cheap. AT&T, really expensive right now. Similar stocks that you can take a look at would be like stocks like Pfizer. Pfizer is another stock where you can see, looking back on the broad chart, looking at it on the weekly, you can see the same scenario again presenting itself, where back in 2000, right? We see it right there. Pfizer at $45. The market says you're overpriced. I'd rather wait for a pullback, wait for maybe for Pfizer to come back down here to that $30 mark, where where there's a little more value, a little more opportunity for upside, and then add to it as it pulls back maybe to that $25 mark. We're not quite sure where the market is going to go. And of course, depending upon how the coronavirus affects other countries, and of course how other countries react to what's going on. Not every country is equal in terms of their ability to deliver quality care. But in any event, this video is getting a little bit longer than I wanted to. It's just a quick update. And of course, I am still paying attention to what's going on. But like I said, I would definitely pay attention to see how the market reacts to that 27,000. If we break below 27K, I personally will be waiting and watching the market, because more than likely the market will retest 24,000, and that's where I'll look to maybe add a little bit more liquidity to my M1. So that'll give me opportunities to kind of store up a little bit more cash. If you're working a 9 to 5, this is it's a great opportunity to try to get some overtime, stash a little bit of cash away for those big market pullbacks, so that we're buying stocks a little bit on the cheaper. Market is very, very overvalued at this point. But in any event, I appreciate you guys watching. If you feel, if you want to leave any comments, if you have any questions, feel free to leave them in the comment section. And of course, feel free to subscribe so that you don't miss out on future content. Thanks for watching. Take care. God bless.